Is there a way to lose money on this deal? That's what I look at. I don't look at everyone's going to be a home run out of the park, because if you're doing that, you'll never buy a deal. You'll never have any growth.
Welcome to the Real Estate Executive Thought Leadership Podcast, a commercial real estate industry show featuring insights from executive thought leaders.
In this episode of RE EXEC TL, we chat with Anthony Scavo, Senior Managing Partner at Basis Industrial, one of the largest small bay industrial operators in the country. Anthony built Basis from a 3-person team into a 54-person firm in 4 years, acquiring more than 7 million square feet of small bay industrial across Florida, Texas, and Atlanta. We talk about why small bay industrial has become one of the most competitive asset classes in commercial real estate, how Basis creates value for investors by executing disciplined business plans rather than holding assets for fee generation, and how Anthony thinks about market selection, deal underwriting, and the risk calculus behind aggressive growth. Let's get started.
Hi, Anthony. Welcome to the show.
Thank you. Thanks for having me on.
Appreciate it. Please tell us about your industrial real estate background.
So actually, the first foray I had into industrial real estate was at a Basis. Before that, I was mostly into multifamily, some office, commercial, things like that, but not truly focused on industrial. And actually at Basis, we started with self-storage development, and we verticaled into, about a year after I came on, into small bay industrial.
Let's talk about your company a little bit more. What does your company offer and who do you serve?
It's pretty, like, what we call it, I guess it's a niche sector of industrial small bay. And our definition of small bay is really suites around, on average, 5,000 square feet or under. That's what we try to buy. So it's the small business owner of America. That's our tenant. A lot of people, we kid around, they come from their garage to us, and they stay with us till they either buy their own building or they move into a building a size we don't have, right? So it's like an incubator space for the American small business owner, and we really like to service them. We treat the tenants as customers, and that's who we try to serve.
So what do you do best? And then how do you express that value proposition to your prospects and your clients?
It's difficult sometimes. We try to stress that our property management company, Base Space, is tenant first, and we give a better service level than some of the other competitors. And we really want to treat them like they're part of our team. We have ice cream socials with the tenants. We just rolled out someone always answers the phone, like an answering system. 3 people get alerted if the tenant has an issue. So we're trying to really call it the top operator in the space. But sometimes you run into difficulties that cost something, and you charge back the tenant for these costs, and then they object to the cost of it. So you have to play that. There's a little bit of a dichotomy about that. You don't spend too much that they get overwhelmed, but spend enough that they're happy. And that's what we're trying to balance every year over year.
What geographic markets are you operating in and what are your plans for growth?
So right now we have a very large presence in Florida, Texas, Atlanta. So we're trying to expand more in Atlanta this year, probably get to about 2 million square feet just in the Atlanta MSA and the suburbs. And then next year, we actually in the middle of a growth strategy plan and determining what the next market to go into is. So we're just trying to be a little bit more careful than we were and do a deeper dive. We hired Ernst & Young, and we're doing some stuff ourselves internally with investigating some markets in specific. Everyone knows certain areas are great because of migration, still population growth, people fleeing taxes and things like that. But really to notice some markets, in those markets, where to go could change a lot of the behavior of the tenancy. So you have to really get that deep into this, even though everyone they buy industrial real estate in Miami, for instance. They buy industrial real estate right in these markets. Yeah, in certain markets and MSAs where it's so overpopulated and the growth is going that fast, it could work. But in markets that are harder to get a presence in, you have to be a little bit more careful.
What are some of the most important demand factors or market conditions that you look at? And also in particular for the key markets that you serve?
Yeah. So general ones are just demographic and geographic stuff, right? Population growth, wealth, the amount of businesses that are there, and the growth of business, like the business environment, if you will. Do they make it easy to open a business? Do they make it easy to operate? That's just the regular, like, call it generic factors that everyone looks for. And then other things we look are, is there even small bay there, right? Is there enough industrial with smaller suites in that area? Because some areas just don't, it was never built. There's not even anything to acquire. So why are we looking, right? So that's something else we do a little differently. And then also other general things. Is it close to a highway? Can a business operate out of there? Is there enough population in a 5, 10, 15-mile circle that could support a business like that? So we do it from 3 different realms: the customer experience, our investor experience, what they want to see. And then in the middle, is it even worth our time to go to if we could acquire 1 or 2 properties? You go to a market, buy 1 million square feet, and actually own 80% of the small bay. So there's some areas like that. So you don't want to, if there's enough to do that and you could do it 1 transaction, maybe. If it's going to be a dogfight, fighting, it's not worth the time. So that's the other thing you have to look at.
Can you share some insights on creating value for your clients and investors?
Yeah, listen, people got to realize in this business and most businesses, right? But in real estate specifically, if you're an operator like we are, right? So in the real estate, there's operators, there's investors, right? And there's a lot of people with a lot of money called limited partners, investors, things like that, that don't really want to be in the operation side because they have to put out billions of dollars. They don't have time to operate properties, right? So it's a little, they're an asset manager, we're an operator, right? So people allocate dollars to us, we go invest it for them, and we operate the property. Our value add is taking a property from 80% occupied to 100% occupied, going in, spending, for instance, the one we're closing on in 2 weeks in Atlanta, we have an $8 million CapEx budget to deploy over 3 years. And that's a lot of money to spend on 700,000 square feet. So you have to have the operational capability to deploy that capital, increase the value by spending the money on the property, right? And still retaining the tenancy and increasing rate. But when we add value, we're not in the business of just keeping it for fee generation. We want to sell and get our investors value. So once we're done with our business plan, we usually either sell it or we recapitalize it, right? Because we're not just holding it on just to bleed the investor dry. That's not what we do. So a lot of it's do your business plan, execute your business plan, go to your investor. How do we want to monetize the situation that we have a stable asset, right?
What trends and challenges do you see in industrial real estate? And then how are you adapting?
There's a lot of, it's kind of weird that we're in such a market like we are. Like interest rates are very fickle, and it's because of what's going on in the world. And I don't want to be too political, but in geopolitical things, like interest rates were looking to come down, right? Then with the Iran happened, the war, oil's going up, and now they're saying there's inflation. So the interest rate market seems to be like basically stagnant. So that hurts our business. It just does, right? Cheaper money helps real estate in general, just not just industrial real estate. So that's one factor. The other trend you're seeing is that there is a lot more competition in this space because industrial is the bell of the ball right now in real estate. It's one of the only things that have yield. So people chase yield in real estate. There's really no yield left in multifamily unless you have an amazing site. Everything else, a lot of lenders just have office and things like that off the table. They just won't invest in it. Or you have some niche asset that you may be able to buy. Some people invest in marinas, they're investing in resort hotels, city hotels are again dead. You're in this little point where we're the bell of the ball, and small bay is becoming a known asset class. When 3-4 years ago when we started, there was no one doing it, right? There was like maybe one or two players. So you're getting a lot more competition on deals, and it's harder to find deals, right? If I'll just give you an example, there was a marketed deal in Miami. There was 42 bidders. Two people bid on one project. Okay, so and we were like 39 out of 42. So you can see how value oriented we are. So there are people, I would say, overpaying for these things, but maybe what a property's worth is what someone will pay for, right? So no one knows what it's worth till it really goes out to market and you determine that. So I think a lot of people, number one, money's coming back into real estate in a bigger way than it was last year. So people have money to put out. And these funds that have 10, 15, 12-year horizons that aren't a closed-end fund or an evergreen fund, they could buy stuff and just say, okay, we have confidence this is going to be worth 10% year-over-year return. We think it's going to be worth that. So we'll buy it at a little higher price because we'll give up some dollars in the beginning and keep it on the back end, right? We don't have money like that. Our money's shorter term. So we have to be a little bit more careful what we buy. So those are the trends I see. There's a lot more competition, and I think the interest rate environment's still going to be sticky. Until that's loosened up, you're still going to see this choppy real estate environment.
Okay, so let's talk about leadership because I want to understand how you help build a company. How would you describe your leadership style and how do you motivate your team?
The Socratic method, if you will. I ask questions and let them answer them. Some people don't like that. Some people feel it's a little sarcastic. But listen, I grew up in Brooklyn. I'm from New York. I'm in Westchester now. If you were in the work environment I was when I was young, that's how people taught. It wasn't like it wasn't given to you easily. You had to earn it, and they wanted you to learn by doing it yourself, making mistakes, right? I think that's the best way to learn. I would say my leadership style is both sometimes harsh and sometimes very flattering. So I do both. I think people need to have a little tough skin. If you do something wrong, you should be called out for doing something wrong. And if someone asks for help, we give help, right? So that's what we try to do. I just don't like when people repeat mistakes over and over again. So I get very hard on those. But I think, listen, we started with 3 people. We're at 54 now. We did that over 4 years, which is a very fast growth. And our employee retention has been much better now. So there was a lot of hiring, firing for a while till you build that team. Our team's pretty good now. Everyone seems to be, and we do offsites twice a year because a lot of people are remote to get that camaraderie. So we're trying to build some kind of a corporate, call it some kind of corporate governance, corporate guidance, some kind of plan of togetherness, even though we're not in office, which is hard. It is hard when you don't have when you have people next to you all the time, it's hard, right? I would say 50 to 60% of our team's remote most of the time. So we try to build that even though that remoteness is there. And a lot of the departments seem to have a good camaraderie, right? Like the accounting team, they're all remote, but they talk to each other a lot. They're all friendly, they're all like that. And then you have the property management teams all in geographic areas, but they're all in offices together at the properties. So sometimes we got to battle that little bit of like, they're like the little clingy environment of themselves to open that up to the rest of the company. But we have asset management calls twice a week when everyone's on. We try to build that. We try to make them light. Sometimes they get serious. Sometimes they get a little heated, and but I think it's good that everyone sees each other and talks.
Let's talk about marketing so we can understand like how do you build your pipeline? How do you sustain that? So what marketing strategies are you using to grow your business?
For marketing, we do this. You want to let the podcast, the interviews, the things like that help. Just because lenders Google people, they just do today. I'm still, maybe I'm older than I look, or maybe I'm not. I don't know. But when I grew up, I'm like one of those. I was born in '77, so I grew up without computers, and I got them when I was older. So my first thought's not to Google someone. So I don't usually, but I think most people do now. So you want good press about yourselves and your business, and that's what we're trying to build. So that's how we market ourselves to investors and LPs. And also, listen, we have not the brand, but we have a great reputation basis with the brokerage community, with the investment community. Listen, not every property's on run. That I'm not saying, but we do what we say what we do, right? We're honest and we're totally forthright. We put our investors before ourselves, and everyone knows that. So I think that helped us out mostly. And the rest of it's people like that. They hear what I say. I get a lot of comments from things like this. They listen to it. They're like, wow, I never heard that insight about Small Bay. And that really helps us get that. I think that next little notch up with some of the LPs and investors.
Are in-person events and networking still important?
Yes, especially the big conferences. Yeah, they're worth going to. You meet, because you wouldn't meet, everyone knows each other probably knows each other through tangentially through someone else from reading an article, right? But when you're at these things, you have meetings. Most of the time, you're not at the event. You have meetings with, that's the funniest part about it. You pay $2,000 to go to something, and half the time you're in the lobby just talking to different groups of people. No one goes in the event. And that's what it's for. So I think it's really just to force everyone off their phone and off the work into a group where you talk to everyone. So I think it's still important, yes. And listen, for younger people, it's very important because they don't even know how to do it. So they should be out there. They should be out there networking. Meeting someone and talking to them is the best way for them to get to know you. And listen, even if they don't want to invest with you right away, right? If you're trying to raise money, you're trying to build a business, stay around. They keep seeing you at places. They're like, oh, these guys are still around. They must not be that dumb. It's just a very simple way to say it, but it's true. And we got our first big, call it programmatic joint venture just recently, right? Where we could go ahead with $400 million. It took time. It took 3 years of building a company to get that, right? Before that, we were raising money deal by deal. So it happens. You just have to be diligent and pursuing. You can't give up. You got to keep going and keep building a business.
What has been the most crucial element in building your brand?
I would say the honesty and the forthrightness to the brokerage community and the people that sell deals and buy deals. We're known out there that we always close. It might take us some time. We might have to put some more deposits up to get some time, but we always close. We have not put a deal and went at risk on it and did not close. And we bought 7 million square feet in the last 3 years. So it's a very active pipeline. Everyone knows about it. So that's been our biggest thing to acquire deals. I think our biggest thing with investors, they know we don't lose people's money and we put their money above our own. So that's the biggest side with the investors.
Where do you envision the Basis brand going in the next 5 years?
Listen, the best possible case would be Basis together. We aggregate enough to go public or do a mass exit where we sell the platform and the management company. And we keep working on that and we build that up to call it $5 billion REIT, something like that. That'd be the best case. There's other exits as well. We're getting big enough now to do it. We're probably the largest manager in small beta in the country, at least the manager, right? And we're on the last list. I think we're third as an owner, fourth as an owner. So it's pretty good. And if you really went to true owners that aren't a fund, we're probably number one. That has all different pools of capital. That's doing like call it the more simple old school way. We don't have one big fund we're investing out of. So we're probably the largest owner like that in that realm.
Has your firm won any awards?
Yes, we've won. We were lucky enough to be honored by the Commercial Observer twice. 2 years in a row as Industrial Deal of the Year and Most Interesting Transaction. And then we were also ranked, we're always ranked we've been ranked in the top 5 once, number one once by South Florida Business Journal as the fastest growing companies in Florida. And we're always honored as the top business people in Florida every year almost. So we've been very happy about the accolades. were never anticipated, but we're always very thankful. And I like when our deals are acknowledged or our teams acknowledged. I think that's more important than our company itself because the team builds these deals. It's good for them. And now they're asking some of our employees and colleagues to speak at events, just not always us, which I think is even more interesting. Give them, especially the younger groups, like they'll tell them, what do they think about acquisitions? What's going on in there with their people? It's an interesting way to look at things, right? Because the business changes so much and so rapidly because especially with the technology coming in, people don't realize it's changing a lot, right? Like people could do research now in 10 seconds when it used to take them like 6, 8 months to look at a market and decide that they want to go into it. You could use Claude or one of these things. They'll write you a white paper. It's pretty good. If you read it, you might know that they wrote it, and the younger people got to learn they have to fix it first a little bit. But it's pretty detailed, and the more you ask it, the more it gets detailed, right? So I think those technologies are going to come. I don't see totally automated acquisition software or something like that coming out. There's just too many different things you have to weigh, right? I don't see AI doing that for a while at least, but it will get there, right? But when you have to, and that data is, they can't get that data. Sometimes you have to pay for that. So that's the other problem, right? So some of the data sources, once you have, if someone builds it, I think they'll get a real estate AI system sooner or later, but enough people are going to want it first. So I think you got to get that next generation coming in. When they outnumber the older people, you'll start getting that. Right now, it's still the old school way. I know the market better than anyone. And a lot of brokers used to just specialize in that. People don't realize they were like people, that was their job, to be like the guy in that one niche market. That was their job. And I don't think you're going to have that in a couple of years.
All right, so let's go to the conclusion. How can listeners learn more about you and Basis?
Go to www.basisindustrial.com, .basespace.com. I think you like what you can also listen to the podcasts. These are great. I think people learn about business, learn about real estate. It's great. I get so many emails from people about these, and the questions they ask are, I think, are very like I wouldn't think they were asking those questions. I would think a lot of people ask, what should I do as a young person? Like I tell them straight out, what you just said, go to networking events, find someone you want to learn from, even if you don't make that much, and learn from them. People don't do that enough. Like, I'll just give you an example. I'm not going to say any names. We're searching for an analyst right now. I hope someone will listen. They've never had a real job before. They're getting a master's, great. It's expensive, I know. But they're asking for like money that a 5 or 6 year person would get because they got a master's. I'm like, but they've never had a full-time job before. And that's fine if you're going into an analyst program for a huge bank where, you're going to stay a couple years. But if you want to go learn how to be in an entrepreneurial company and learn real estate where you have a flat environment, there's no siloing, you're not going to get paid that much. You're going to get paid less because you got to learn yourself here. There's no like program to teach you in small companies, right? So people have to realize that. And if that's what they want to do, they should do it young, before they have responsibilities, before they have to worry about their kids, and before they have to worry about other stuff. Go do what you want to do now. Go learn, make a little bit less money, get your situation right, get confidence, meet investors, meet how to run a business, and then go do it yourself before you have to worry that you can't take risk, right? That's going to happen. It's going to be quick, especially if you're with a significant other early or something like that. You never know what could happen. Like by the time you're 30, then you're going to be, oh my God, what do I do? I can't take a risk, and you're going to be stuck in a job you don't like. So you got to. Mine was just totally accidental how I got this. I would have been at the same job I was at for 26 years. I would have still been there. But I got something happened in my life, gave me a development. I went into this, and now I'm an entrepreneur, which I never thought I would be. So it's interesting, but if that's what you want, you got to start young. Don't start. The older you get, the harder it is to do.
Yep. Thank you for sharing your story. Okay, one more question. What is
Sure.
one closing insight you'd like to share for executives targeting growth?
Growth. Be aggressive, but be careful at the same time. That's what we live by. Listen, you can't always have rose-colored glass on like your acquisitions team. You got to weigh things, but you can't always say no either, right? So there's got to be some deals that are on the edge. You might have to say yes to if you want growth, but that's the risk of growth, right? And growth is tricky to do it right, but always remember in the back end, don't lose money. You don't have to make money every deal, just don't lose money, right? Like investors don't hate you if you give them back their money with a little bit of interest, but they hate you if you lose it. So you don't want that against you. So always make sure you have a deal that you feel there's enough margin to say that you'll never lose money, right? And that's the biggest thing I wear in every deal. Is there a way to lose money on this deal? That's what I look at. I don't look at everyone's going to be a home run out of the park, because if you're doing that, you'll never buy a deal. You'll never have any growth. So you have to always weigh it like that. Get some home runs, get some singles too, right? Get your batting average nice and grow. And by the time, if you're in a business where growth, when you grow things together, makes it more valuable, like an aggregation strategy. Some businesses are like that. The more market share you have, the better it is. Then you have to grow more aggressively because that's the only way it works. So those are the things I think that people need to learn. And a lot of people are too risk averse, and some have no risk averse. You got to find that happy medium, and that's part of what I do, right? I go between the rose-colored glasses of our acquisitions team with the black glasses that some of our people wear. So you got to be between. Say, I want to pursue this deal. I think, and I spell out a point to our investment committee, and we go forward, right? Every time I've presented something to go, it's been approved. So I all the diligence is done before we go there. So that's what I do. That's why I'm like, I guess I'm the chief growth officer, if you will.
Thank you for joining us today, Anthony. We appreciate your insights.
Thank you, bud. It was really good. This was really fun.
Thank you, Anthony.
Thank you for listening to RE EXEC TL. Please like and subscribe for updates on upcoming episodes. Share the inspiration.